we have with us someone who has seen the global financial crisis 8 years ago from the inside. He has experienced the thick of things firsthand and has contributed to the solutions the Fed offered in stemming the catastrophe, so to speak. He is the Norman Bobbins Professor of Economics at the University of Chicago Booth School of Business. Let me introduce on the show Professor Randall Kroszner, joining us with his perspective on global macros as well as India. Professor Kroszner, thanks very much for taking out the time. Really appreciate you joining us today. You were on the board of the Fed governors between 2006 to 2009, right in the middle of the global financial crisis. Perhaps then you are one of the best placed people to make us understand how far have we come from the scars the crisis laid.
So one of the concerns that I have is that measures of economic uncertainty and risk are at very low levels. The so-called fear index, the VIX index in the U.S., is at or near record low levels. If you look at a variety of risk spreads for different instruments, they tend to be at very low levels now. And although I think there is reason for optimism because we are seeing pretty reasonably good growth throughout the world, whether it's in Europe, US, China, most emerging markets, not including Brazil, unfortunately. I'm still a little bit worried that there's too much complacency in the markets, that people are sort of pricing everything to perfection, as they sometimes say, and that I think there's real risk out there, whether it's policy risk on execution of different programs in the and regulatory and tax reforms in the U.S., or whether it's geopolitical risks or other political risks that are around the world. I mean, obviously there are issues in North Korea, there are issues in the Middle East. It just seems that markets are a little bit too sanguine, and I would prefer if they showed a little bit more concern, a little bit more fear than they're showing now.
Afternoon, and thank you for joining us with your world opinion on ET Now. I want to talk about how much the economy has really healed in order to justify the kind of hikes that we've seen so far.
In the U.S., we've been growing at roughly 2% per year since 2009, really since the end of the financial crisis. And it seems that no matter what the kind of shocks have been, whether it's the Euro crisis, whether it's geopolitical shocks, whether it's terrorist events, other unfortunate events, it seems that we are been growing around 2% in the U.S. We've had a very significant increase in the number of jobs over the last few years, so the unemployment rate has come down from 10% to now less than 4.5%. Inflation remains quite low. It's below the 2% the 2% target for that the Fed has, and it is one of the questions that people have about, well, why is the Fed raising rates before they're actually seeing inflation get to their target? I think the reason for that is that the Fed doesn't want to be behind the curve. If you look in the long history of the Fed, they often have been behind the curve. Inflation's gotten ahead, then they have to raise rates too much to try to wring the inflation out of the system, causing a downturn. So the Fed is trying to stay a little bit ahead of that. That's why they're moving things gradually. It's always hard to know exactly how inflation will evolve or how the job market will evolve, and that's why it's not perfectly steady in how they're raising rates. But it is a very gradual and very slow process. And I think we're likely to see a little bit more wage pressure going forward. The job recovery has helped to bring down some of the broader measures of unemployment, not just the traditional one, which is now at less than 4.5%, but some of these broader ones that have been at 9 or 10% are now down at around 8%, which is closer to the average spread between those broader measures and the traditional unemployment rate.
I just wanted to touch upon, the way ahead on rate hikes as you foresee it. You'd call for faster hikes in 2017. We're going to be looking on balance at 3 rate hikes. Is that good enough?
I think really the key is how the economy and how inflation evolves. I think we certainly have had 2 already. The Fed had forecast they were likely to have 3 throughout 2017. My guess is that since inflation has been relatively flat to slightly declining, that the Fed is likely to wait until towards the end of the year before they might move again. But it'll really depend on how things evolve over the next 6 months.
You know, Janet Yellen recently commented on President Trump's growth target of 3%, saying, you know, this would really look challenging, would love to see it look challenging. What exactly is your view?
So I'd say it's most likely that we're going to see around 2% again for this year. We had about 1.5% in the first quarter. We're likely to have between 2 and 2.5% in the second quarter, and so probably a growth rate of around 2% for the year, roughly the average we've been having over the last few years. Because there really hasn't been an opportunity for the types of policy changes that President Trump had proposed, some significant changes in regulations, some significant changes in the tax code. If those do happen, then there's a chance that could have the growth impacts. But probably since the legislation hasn't even begun to be debated yet, that's not going to happen, or it wouldn't have an effect on the economy until at least 2018.
You know, the world is over inflation, undershooting central banks, and a large part of it is due to the low crude prices. Some inflation is good and productive to enhance growth, but that doesn't seem like it's coming through, does it?
And so it seems to have been a challenge for all the major central banks around the world to get to their inflation targets of around 2%. One exception to that is the United Kingdom, where inflation is getting close to 3%. That really came from their change in policies, the Bank of England's change of policies after Brexit, significantly cutting interest rates and significantly starting an asset purchase program that reduced the value of the pound, and that's one of the factors that has raised prices in the UK. So that's the one exception where we are seeing above 2% inflation of the major countries. And so the forecast is that as the recovery continues, whether it's in the US or in Europe, you'll start to see a little bit more wage pressure and a little bit more inflation pressure. We'll have to see. That has been anticipated for a number of years. It's been slow to be realized. But as I had mentioned earlier, when in the US now these broader measures of unemployment have come down so much that they're back in their historical ranges, and when they're in their historical ranges, we're more likely to see the historical relationship where we'll get a little bit more wage pressure and a little more inflation pressure going forward.
Do you expect the global financial markets to remain calm as the Fed starts reducing its balance sheet? Any taper tantrums coming back to hound us? Could you see signs of that soon enough?
Well, we certainly hope so. And so far, the markets have reacted very calmly to the Fed's mentioning that they are actually going to reduce the size of the balance sheet. Remember back in 2013 when Ben Bernanke just talked about the possibility that in 6 to 9 months they might slow the rate of increase of the balance sheet. That caused the taper tantrum, capital outflows from India and other emerging markets, decline in the value of the rupee and other emerging market currencies. We haven't seen any of that. And in some sense, this is a more fundamental change that they're proposing, which is to actually reduce the size of the balance sheet rather than simply reduce the pace of increase of the balance sheet. And so, so far, things have been calm. We hope when they do start this later this year that the markets will remain calm, and that's really what the Fed's goal has been. One of the Fed policymakers has used this great phrase. He said that he wants to make the reduction in the size of the balance sheet as exciting as watching paint dry. And that's so far what they've achieved. The market's been very calm. It's been totally boring. It's just like watching paint dry. We'll see when they actually start the reduction in the size of the balance sheet, whether we get an impact or not. But they're going to start with such a small amount of sell-off each month that it's unlikely to have much of a big impact.
It's been a pleasure having you with us on the show. Thank you so much for joining in with your expert insight as well as outlook on the global economy, the kind of growth projections that have been put forth, as well as the rate cuts that have taken, and clearly how far we've moved from the kind of scars that we've seen of the overall global catastrophe.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.